Hey, welcome back to the Algo trading series. This is part two, and we're going to go over some of the tools and some of the knowledge that you're going to need to learn to be successful in algo trading. Now, I'll preface this by saying that you are going to have to learn how to program. If you don't want to, and that's fine, there are lots of people out there that will license you access to an algorithm. You can see one on the chart behind me. It's one that I made. It's one that I license access to, and the description's below. But if you want to make your own, and that's what we're talking about here, you're going to need to learn how to program. Now, previously, we mentioned a little bit about that. The software that I'm going to recommend is TradingView. And the reason that I recommend that is because of its robust backtesting engine. And we'll go through that a little bit here in just a moment. Now, this type of backtesting engine is incredibly useful, and it's very difficult to find, at least presented in this sort of format. So that's why I recommend the TradingView one. Now, you're going to have to learn PineScript as well. That's TradingView's built-in programming language. It is grammatically very similar to Python. So everything, for the most part, I guess not everything, but a lot of what you learn with PineScript is going to transfer directly to Python, which if you're really interested in algo trading and learning how to do like machine learning and AI and stuff like that to help guide your investments in the markets, you're going to eventually gravitate to Python. So PineScript is a great place to start. So let's talk a little bit about the TradingView backtesting engine. And you can see this is currently running one of my scripts that I'm testing. I'm trying to test it on different tickers and different time frames to see what I like. I like this one so far, and we'll look here through the backtesting stuff. All right. So you can see here on the main page, on the overview page, it's got your net profit, total trades that it's looked in this time frame, the percent of those trades that are profitable. And keep in mind, this includes both closes during the trade and the final close. So if you look over here at this trade it's currently in, this right here is counted as a profitable trade, even though the trade isn't closed yet. All right, we've got the profit factor. This is essentially, well, it says it right here, gross profits divided by gross losses. If you take your losses, right, so if you lose $100 on average when you take a loss, but when you take a win, you make $377 on average, you get a 3.77 profit factor. For an algorithm to be profitable, it has to have a profit factor of over 1.0. The profit factor is probably the biggest thing that I'm going to look at when I'm making an algorithm, when I'm changing settings around, when I'm trying to figure out what I like. The profit factor is probably the biggest part of that, for me anyway. Now I'm sure there's, again, as many different schools of thought behind this as there are algo creators. But my thought is that if you have a high enough profit factor, you can absorb a lot of problems. And when you're talking automated trading like this, especially automated trading from TradingView, you have slippage to account for. And slippage can throw a pretty significant wrench into the works. TradingView does have a way to implement slippage into your algorithm testing. I'll show you that in just a minute. But when you baseline test stuff without slippage, you're going to want a very high profit factor to account for things like that. It just essentially, the more money you make, the easier it is to cover up mistakes and end up with a profitable equity curve. Now, your drawdown over here, max drawdown is essentially It takes whatever value was the highest cumulative total that you received, and then as it draws down, you can see these bars here which indicate drawdown. It will find the lowest, or excuse me, the highest drawdown from that previous cumulative total. So if you look right here, this was the previous high that I'd found with this algorithm, trade 101, and currently it's well, actually the trade just before this one, this one's not closed yet. The largest drawdown it had from there was 6,343. Drawdown is important. You don't want that percentage to get too high, anything over about 10%, and I'm going to start looking for a reason why. Drawdowns happen. Obviously, it's going to happen because you're going to have losing trades, but you don't want to have too many losing trades in a row. Right now with this algorithm, I'm going to watch it and see what it does, and see if it keeps having losers here recently. Then I'll have to look back through and see where my settings need to be improved. Again, this is an algorithm that's still in testing. Now, the algorithm and programming itself I know are profitable, but what I'm testing are the settings. You can see all the settings on the right side of the page right over here. And this is an algorithm that's it's available for license on my sites, the ADX MACD Confluence algorithm. It's based off of the ADX MACD Confluence indicator I have for free. You can go find it on TradingView. It's Trader's Ultimate Edge, and it gives you basically these buy-sell areas based off of ADX MACD confluences. So you can just go get that for free if you want it. And so what I'm doing is testing all these to see what happens here with the equity curve. Now, generally, you're going to want an equity curve that goes from the lower left to the upper right, much like this one does. Okay, and you want it in a more or less smooth manner. This one's fairly smooth. It's got peaks and valleys, but more or less, it's pretty smooth. And that's what you want, because that sort of smooth equity curve is what is going to help you moving forward. Now, backtesting suffers from something called backtesting bias, wherein if you cherry pick trades, and you cherry pick settings and trades to be perfectly set for what happens in the past, there is the possibility that your algorithm will not perform the same way going forward. And the best way I've found to alleviate that problem is to make sure that my equity curve from left to right is smooth, and that I've got a significant number of trades. In this case, we've got 111 trades, and let's see how long it took to get that. Hopefully it's just a few months. Yeah, this goes back to December 5, and today is February 10. So that's slightly over 2 months, 111 trades in 2 months. I'm pretty happy about that. That's on the 3-minute time frame. So that means that it's done plenty of testing to get this equity curve. So I'm not too concerned there. Now we'll look here under the performance summary. What's really interesting in here, and actually has quite a bit of information, but what's really interesting is going to be right down here. Average bars in winning trades and average bars in losing trades. These are two things I'm going to look at a lot. You want your algorithm to be designed to toss losing trades very quickly. So you notice there I have average bars in winning trades, an average of 24, average bars in losing trades of 6. So that means my losers are only a quarter the length time-wise as my winners. That's very important. That means we are getting rid of those losing trades in a hurry. Okay, very important. You can see up here we have average winning, average losing trades. Sometimes these don't look that great. Like over here on the longs, the winning trades are much lower than the losing trades, but look at the percent that I have profitable. That's how you generate the nice equity curve, and you generate the nice profit factor. So a lot of things go into making a successful algorithm, a successful trading strategy. And it's not quite all It's not quite all as it appears right on the surface. So looking down into some of this stuff is very important. And this is one of the most important things here is average bars winning trades, average bars and losing trades. And then you can come over here to the list of trades like I just did, and you can look through here. And you want to look through here and look at what it's doing. And if you see any trades that are really big, like this one here, you can go back in time and you can look at the trade. And you can make sure that it didn't cherry pick the trade. Right? We've got some really nice winners in here. What you want to do is look at those days. So you'll look at big winners and big losers, and you'll look at the days it traded on. And if that day was something that you never would have let your algorithm trade on, for example, FOMC day, you never let an algorithm trade FOMC. That's just asking to lose your money. So if it's on that day, you can kind of write off whatever it gained or lost on that day, and you can kind of subtract it from your total and look here at what's happening and see if it was a big drawdown that day, well, it wouldn't have happened. Or if it was a big gain that day, well, that probably wouldn't have happened, right? Because you need to filter out the days that you would not have been trading. So backtesting is, I guess, less science and more art when it really comes down to it. And it's very important to understand, and it's very important to spend a lot of time learning how to backtest properly so that you aren't cherry picking. And it's very important to have these things hooked up to a demo account. We can do that through Trade Connect software, through our Trade Connect software. You can hook it up to like a Trade-of-8 or Alpaca demo account so that you can watch this over time for like a month of forward testing and see exactly what it's doing in that environment. So you can see things like slippage, for example. Very important. When you are backtesting strategies in TradingView, keep in mind you have some extra things in here that can change things around, right? You got your initial capital, you set your order size in here. You can set it with contracts, USD, or percent of equity. I just do a flat number of contracts. You set your commission, and then you can set your slippage like we were talking about. I like to go with 0 at first just to get a baseline. And then what you can do is start playing with it to see if every trade had 1 point slippage, what's going to happen, or 1 tick slippage. And you see we're still profitable. We're still looking okay here. We're still making money over time. And at least in my experience trading on ES, if you give 1 point of slippage for every single trade, so right, we have 1 point on entry, 1 point on profit, there'd be 1 point on a close, ticks, not points. That ends up being about right, more or less, if you're trading on ES. But when I'm doing this, first of all, I'm going to put 0 because I don't really want that to play in. What I will do is, as I forward test into an actual account, that's where I'm going to start to look at slippage over time, is going to be in that account, because that's what matters, right, is what you're actually filling at. This can't do a whole lot for you. What else I'm going to look at here is under recalculate. I will recalculate on the same board, on the same bar after the order is filled. I think that's important. You want it to be able to close a position on the same bar. Now, it's not going to be perfect because backtesting has an implicit problem, and that is you don't know what prices in the bar came first. We can make some educated guesses as to which prices came before other prices on that bar, but we don't know for exactly, right? We can use the bar magnifier down here. So, for example, if it goes into if you're on a 3-minute time frame, it can try to use the 1 minute time frame to figure out what happened first. Oh, there it goes. It just did something. You see that right there? It just popped up a close right there. So that would have just sent into my Trade-of-8 account, and this would have been a profitable trade right here. Where was I? I was talking about properties. Oops, list of trades. There we go. So I'm talking about the bar magnifier down here. That sort of thing is important, so you want to use it. to try to give yourself the best backtesting that you can, right? Now, backtesting is always going to suffer from some implicit problems, right? Because you cannot backtest 100% accurately. So that's why forward testing is so important. All we do with backtesting is to figure out a baseline of where to start our strategy at. Then what we need to do is forward test. A strategy like this, I'm going to let run for at least a month before I would deploy it live. And I'm not going to change anything in that month. I'm going to let it run. And then I'm going to examine very closely all of the trades as I can pull them out of my TradingView account. And I'll look at them and I'll go back through the charts and I'll look at them and I'll say, okay, I'll look at all these, I'll get the aggregate total of how I feel about those trades, and then I'll see if any adjustments need to be made. Now that's kind of the same process that you would use if you were trading manually. And the differences between automated and manual trading, yes, of course they're there, but automated trading should be essentially a perfected form of manual trading, right? Because it's a completely emotionless computer doing exactly what you would want to do manually, but it's doing it without emotion, and it's doing it at a faster pace than you could. So you want to treat a lot of your trading with, as far as reviewing them goes, the same way you would treat your manual trading. And, I would want to conduct, a minimum of 20 or 30 trades manually before I was even going to consider making an adjustment. In this case, I'm going to let it run for a month. This particular algorithm would hit, about 50, 55 trades in that month. And that's a really nice data set to look at and to start to play with. And as you get more comfortable going forward, you can even export the list of trades out of TradingView, and you can start to analyze them with Excel spreadsheets on your computer. So in summary, that's a little bit about TradingView, about using the backtesting mechanisms in TradingView. And now your job, if you don't already know it, is to go learn PineScript. So go find one of the million tutorials on YouTube and go learn PineScript. It's actually really easy to learn. It won't take you very long. I think I got really competent in it, and within a couple of weeks, it was pretty simple. And like I say, a lot of it's going to transfer over to Python. So if you already know Python, you're in really, really simple territory. It's just a little bit of syntax change. It's very simple. If you don't know Python, don't worry, because by the time you're done with PineScript, you're going to understand a significant amount of Python. So yeah, that's all I've got for you this time. Next time on part 3, we're going to go into the first of the 3 phases of trade. It is opening, management, and closing. We'll go into the opening phase of the trade, and we'll talk about some very specific opening conditions. And I'm going to walk you through kind of how I developed the ADX MACD confluence and why I use it, and I'll show you how to use it, and I'll give you some code examples that you can take and actually use on your own. The indicator is available for free right now. You can go to the Trader's Ultimate Edge account on TradingView and just check out that indicator for free. The code's all there and everything, so you can get started right away with it. Other than that, you take care, and I'll talk to you next time.